With fresh tariff threats unleashed by U.S. President Trump, a new wave of supply chain disruption could be in the pipeline. Shahmir Khaliq, Citi's global head of services, has a front row seat. He helms a division that powers close to $5 trillion in daily flows and supports the operational backbone of thousands of businesses. He spoke exclusively to CNA's Roland Lim about how Citi's multinational clients are reassessing where to manufacture, where to route trade flows, and how to manage risk.
Clients are taking a little bit of a wait-and-see attitude because, as you've seen, the policy on tariffs and the quantum of tariffs has effectively changed since they've been announced. Previously, we had slightly higher tariffs, then the government lowered them. There have been responses from the other governments as well. So as clients think about their investment strategy, as they think about their CapEx and where they want to build their production facilities, where they want to have their supply chains, can't really be driven by what I would call weekly changes or monthly changes in some of the macro factors. So I think clients are taking a little bit of a wait-and-see approach. However, clients are seeing certain corridors emerge, and I see corridors between what I call North Asia with Latin America. I've seen corridors between North Asia and Asia South. We've seen corridors within Asia and Europe emerge as well. And then there's a lot of interest in investing in the US as well. But a lot of these conversations are around clients exploring options, where to put either their own production facilities or their suppliers' facilities, and thinking about how they want to position for the medium term.
And which regions and economies would you say would be benefiting from these shifts in supply chains?
The southern part of Asia continuing to be a big driver of where a lot of our clients either house their production facilities and also their supply chains. I think we've seen flows in Latin America as well. We've seen a significant pickup in activity between Asia and Latin America. I think there are clients also, as I mentioned earlier, looking at the US as well to see what they want to do from a medium-term perspective, particularly in how they serve the US market. Having said that, I think cost of production is going to be a key challenge, and whether a tariff rate is 10 or 15%, it remains to be seen whether our clients will actually move their production facilities to a significantly more expensive jurisdiction.
Amid China's slower than expected rebound, as well as rising US trade tensions with China, how is Citi calibrating its approach in serving clients with huge China market exposure?
China and Hong Kong together is Citi's #1 international market, or one of the biggest markets that Citi has. And remember, Citi plays a dual role in some of these markets. First, Citi helps multinational corporations come and establish production facilities, supply chain facilities in these markets, such as China, and as I mentioned, Asia South earlier. So that's what we try and do, invite foreign capital and help foreign capital effectively come and establish their infrastructure in China or Asia. The second thing that we try and do, which is just as important, is help domestic companies effectively go global. And one of the things that we've seen, and with a lot of comfort that we derive from, is we've seen Chinese domestic companies increasingly go global.
The Federal Reserve is maintaining a higher for longer policy. What new trends are you seeing in terms of treasury and liquidity management when it comes to your global client base?
A lot of our clients have actually been managing their liquidity much more effectively because, remember, interest rate didn't just go up immediately. We've had higher rates for the last 2 or 3 years as the rates started to go up post-COVID. So our clients have actually already adjusted, and they've been positioning their working capital and their balance sheet positions and their capital market activity accordingly as well. But I do think that as rates continue to come down across the globe, I think we should start to see some sort of a similar picture play out in the US as well. And by definition, we should then start to see, some incremental extension of credit. I think generally speaking, as you've seen, the bank's balance sheets in the US continue to be very strong. You've seen the recent results from the Fed stress tests as well. So I do feel particularly hopeful that the US banking sector continues to be very well capitalized. And I think that positions the economy for continued growth as we think about the future.